Hello and welcome to the Moss Adams Virtual 2023 Building Opportunity Conference. Thank you for joining us today. Before we begin, I'm going to play a brief housekeeping video.
Welcome, and thanks for joining. We're pleased to present our continuing professional education webcast series. Before we begin, please keep the following in mind. You can customize how you view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can adjust window size and placement or enter full screen mode using the controls at the top right of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons that relate to a different aspect of our session. You can download a PDF of today's slides from the Slide Deck and Handouts widget. You can ask questions by typing in the Q&A window and clicking Submit. We'll do our best to answer all questions or follow up via email. If you experience technical difficulty, refresh your browser by hitting the F5 key. Today's session offers 1 CPE credit. To receive credit, you must meet the National Association of State Boards of Accountancy requirements. You must attend at least 50 minutes of the session and respond to at least 75% of polling questions. To participate in the polls, please check the button next to your answer within the slide window and click Submit. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget and download your CPE certificate. Don't worry if you can't download your CPE certificate today. We'll email you a copy in 2 weeks. If attending this webcast in a group, you must complete our group CPE attendance sheet, available in our Slide Deck and Handouts widget to receive credit. Please have all group members sign it and send only 1 sheet per group. CPE credit can only be awarded to participants registered as themselves and isn't available for participants who view the on-demand version. This presentation is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
This is the second of 5 sessions in our 2023 Building Opportunity Conference. We have added a link to the conference sessions in your handouts window. We hope that you can join us for future sessions. Today's topic is Economic Update: Has the Recession Been Canceled? And now I would like to introduce today's moderator, Chad Averill. Chad is the leader of the National Construction, Real Estate, Hospitality, Restaurant, and Professional Services practice. He's been in public accounting for over 23 years and provides accounting and business advisory services to public and privately held companies. Chad, the floor is yours.
Thanks, Carly. Good morning or good afternoon, depending on where you're calling in from. I'm excited to introduce Steve Scranton to provide us with an economic update. Steve is the Chief Investment Officer and Economist for Washington Trust Bank and holds a Chartered Financial Analyst designation with over 40 years of investment and economic experience. In Steve's role as Economist for Washington Trust Bank, he participates in public speaking engagements, as well as authoring multiple communications to keep clients and the public informed of economic and investment market conditions. Throughout the Pacific Northwest, Steve is a well-known speaker on economic conditions and world financial markets. Please join me in welcoming Steve Scranton.
Thanks, Chad, and good afternoon or good morning to everybody. As you can see from the title, I said, are we at the end of this economic cycle? The question is, has the recession been canceled? And what I would tell you is that, as I've said many times, recessions are unique to each business and each individual. But from a general standpoint, I would say, and I'll go in more detail as we go along, but I don't believe that we have changed the business cycle. I think that the business cycle will always end in a recession. The question is when. And so let's just kick off and go through. I think the thing that I want to highlight today is going through what I think are some major challenges that our economy faces, and how businesses respond to these challenges will determine whether or not they themselves experience a recession, whether they go through without any issues. But I think that the real challenge, the first one, is the challenge of interest rates. Everybody asks me, is the Fed done yet? Or have they stopped raising rates? And what I have told people is that this is a Federal Reserve who has been very clear in what they intend to do, and they have done essentially what they said. And so they have said, for one, they skipped raising rates at their last meeting in September, but they said that it's still possible they could raise rates again later this year. They have 2 more meetings, November and December. But I think the bigger message they've given is that rates will be higher for longer. And I think the real message is there is that until they see inflation coming down more, until they see wage pressures abating, that they will be willing to hold rates higher, even when it looks like the economy may be rapidly decelerating, heading for a recession, until they actually get confirmation that we're in a recession and that inflation especially is starting to come down. I think that I can't rule out that they wouldn't raise rates again. I would tell you there's history to support that. The last time we had a Federal Reserve raising rates to battle inflation was in the early 1980s, after we've had a big run-up in inflation in the late 70s. They took the overnight borrowing rate all the way up to 20% to try and kill the inflation growth rates. When the economy started to weaken, they immediately started to cut rates. That proved to be too early, and then they had to turn around, a year later and raise rates once again back up to that 20% level and hold them higher for longer then before they finally started to cut rates. So I still think they will cut rates when a recession does hit, but those who think that just the first signs of economic weakness will be when they start cutting rates, I would tell you, do not budget or plan that way would be my advice. I want to give you some perspective too, because especially for those people who've only been in the business for the last 15 years, all you've seen is low interest rates. And it may seem like that's the normal level. The reality is, this is what I want to show you from a borrowing cost standpoint. I'm showing you both the prime lending rate, since most small businesses especially, but many businesses, they borrow for their operating lines or short-term needs with the prime lending rate plus some type of spread to reflect credit risk. And for term financing, it's the 10-year Treasury. So all I wanted to point out here is that we're at 8.5% right now for the prime lending rate. You can see if we go back to the end of 2006, as we were heading into 2007 and the recession that resulted at the end of 2007, we had the prime lending rate at 8.25%. And if we go back to the 2000, when we had the tech bubble, Fed was raising rates once again then, and we actually were at 9.5% before the recession started. So these are not unusual levels. It's just that people, especially those who've been in the business the last 15 years, these seem abnormally high, when in reality, these are more what it looks like on a longer term basis. If you actually looked at a graph of interest rates going all the way back to the 1950s, what you would see is interest rates around these levels, and then this anomalous spike in the early 80s where they shot up to that 20% level, then settled back around these levels. And then we had the anomaly from 2009 to 2019 where rates were near zero. So I think, again, I'm going to make the argument to you that these are not unusual rates, and I would not be at all surprised once a recession hits, Federal Reserve lowers rates then to stimulate the economy. When the economy starts to recover then, we could well settle back around these levels rather than thinking that we're going to go back to the lower levels that we have seen over the last 10 to 15 years. So I'm just giving you my word of caution that you may discover this is the new normal or the old normal, and that they're not the unusual levels. If we look at it from what are lenders doing with the Fed raising rates, the lenders are responding by thinking, okay, that means higher rates will hurt weaker borrowers more than strong credit borrowers. So they are widening the spreads now on the loans that they make. They're differentiating between a very healthy borrower and a very weak borrower. And the healthier you are, the closer you would come to borrowing near that prime lending rate or the 10-year Treasury rate. The weaker you are now, you're going to have a much wider spread, which is going to make it that much more difficult for weak players then. They're also going through the process of tightening their standards, so it's tougher to qualify for a loan now. So I think that the lenders in the U.S., both financial institutions and others, have gotten the Fed's message that we need to stop spending by borrowing, and they are doing their part essentially by making it tougher for people to qualify to borrow any further. So that's going to have a slowing effect on the economy, that if people were doing their spending because they were borrowing to do it, not because they had the money to do it, that's going to start slowing. And we can see when we look at the next graph, what has happened now is loan demand on the commercial side, at least, has dropped off dramatically. because I think many borrowers don't qualify anymore or are unwilling to pay the high borrowing costs. So I think that is a natural process that the Fed wants to have happen, and I think they want to see more of that to slow economic growth. The real pain, though, has been on the consumer side. When we look at this situation, you can see right now the average credit card rate for those who carry a balance on their credit card, which means they're paying interest when they're making their monthly payments, is 22.16%. Kind of staggering to understand that. Even that is differentiated, though, by your credit score. If you have a credit score over 600, you're probably getting a credit card rate more in the 17 to 18% range. And if you have a credit score or a FICO score below 500, you're probably paying close to 25%. And you can see on a historical basis, using the same time frame I just gave you for corporate borrowing costs, this credit card rate is far higher than it was during previous recessions. And I think it's once again part of it because we have seen such an increase in borrowing using credit cards that the credit card lenders are becoming extremely cautious and trying to weed out the weak players again by making the rates extremely expensive. They've done the same thing that financial institutions and others have done for businesses. They have increased the spreads. So once again, your FICO score is going to tell you whether you get a good rate, a bad rate, or a horrible rate. Although I would argue even 17% is not necessarily a good rate. And they've also done the same thing. They've made it harder to qualify. So I think this is one of the challenges we need to watch for the economy, that especially for the consumer, since the consumer makes up almost 70% of economic growth, consumer spending, if we're now making it very hard for a consumer to be able to spend unless they actually have the savings or the cash for it, that should start to slow the economy. And then the question becomes, are rates so high now that it slows the economy all the way to a recession or not? So that's the running debate right now. Is it going to be a soft landing? Is it going to be a recession? And that question is still unanswered at this point. The pain is also taking the toll for the consumer. Their demand for borrowing has also dropped off. And I think that is really just showing the natural process of what happens when you start to make it more expensive to borrow and much tougher to qualify to borrow. So let's go ahead and stop here. Let's take our first question. Just curious for the audience, what do you do with your credit card payments if you purchase with credit cards? Do you make a minimum monthly payment? Do you make a partial payment? Or do you pay off the balance? So I'll let Carly turn it over and run the poll for us. Then we'll look at the results.
Absolutely. Thanks, Steve. And the polling questions are located on the slide. So please make sure you have your slide window open. I'll give you a few minutes to respond. And to respond, please click the button next to your answer and make sure to hit submit so that it tracks your CPE.
One thing I would reflect while we're waiting for the results is we have seen a change in trend where credit card delinquencies and charge-offs are rising. If you look at it from a macro big picture, it doesn't look that bad. But if you go below the surface to the subprime borrowers, we're now into double-digit default rates and delinquency rates. So I think that there's signs of trouble beneath the surface that haven't really bubbled to the top yet for everybody.
And here are the results, Steve.
Okay, well, that shows probably, given the audience that we have of professionals, that it looks like most of you are using your credit cards to get your reward points, and then you're paying it off at the end of the month. And I think that's a good thing, but I would tell you that there are clearly a group of people that are not in that scenario. So thank you for responding to that polling question. So let's look and see what lies ahead. And I'll tell you already, just from the time frame of when I submitted the slides, we've had some changes in rates on the Treasury side. So I still think the Fed funds rate currently are at 5.5%. I think they'll raise it at least one more time to 5 3/4. They could raise it to 6 if we don't see inflation coming down more than what it has so far. 30-year mortgages, 6.5 to 7.5 is kind of out of date now because today we've got a 30-year Treasury at 7 3/4. So I think we may well test, at least from a psychological standpoint, mortgage rates up to 8% potentially, but I think you're probably between 6.5 to 8% for mortgage rates. All I would say for mortgage rates is that don't count on saying I'm going to wait for a recession because then I can get a 3% mortgage again. We never should have had 3% mortgage rates. That was an artificial rate created by the Federal Reserve. I think when a recession hits, we'll come off the 7.5 to 8% level, maybe back down to 5.5 to 6%. but I still think long-term we may discover, like we used to see, mortgage rates somewhere in the 5 to 7% range being normal. Credit cards, that's still the ugly part. We are still looking at 22 to 25% on that, and I think those are going to be slow to come down. And the last one, which I apologize I skipped over, the 10-year Treasury, if you're looking at term financing, we are sitting right now pretty close to that 475 level. I think still 3 3/4 to 4 3/4, where it bounces around, it may bump up and maybe make an attempt to get towards 5%. But I think that it's going to be kind of range bound there because it's done a lot of anticipating already of where they think inflation and the economy will be. So then the second challenge is the labor force. What I hear over and over again from businesses is, I have plenty of business. I don't have enough labor to meet all the demand there. That's true in the construction industry, the retail industry. You can almost go down the line. It used to be before the 2007, 2009 financial crisis, I was hearing that mainly from construction and from manufacturing. Now it's pretty universal, saying it's tough, finding enough people to fill all my open positions. So let's take a look at some of the dynamics going on there. One of the things that we see, this is from a US standpoint, we are still creating jobs. And this was before last Friday's jobs report, where we added over 300,000 more jobs. So it is a case there that we're creating jobs. People are coming back into the labor force, but we're not apparently creating the jobs for the industries that need those positions to be filled. And I think that is part of the mismatch we still have going on there. One of the things that I like to look at, this is from the National Federation of Independent Business. So it kind of gives us the picture of what's going on with small businesses, because they're kind of the heart of American growth, is that there's small businesses in every city and town. Big businesses are really only in the metropolitan areas. And what this is showing is a survey they do each month. We just got an update this morning. But what they show is, from a job standpoint, the red line is saying what percentage of the respondents are saying they cannot find enough qualified help. And we're at 56%. It bumped up a little this morning. So we're not at the peak that we saw back in 2021, where 62% of the respondents said that was the case. But we're still higher than where we were back before the pandemic crisis. Looking back to 2018, it was only 52% at that time. So this is an ongoing issue for businesses, and it's created wage pressures as a result. The light blue line that you see there, that's job openings. And what we have clearly seen is, I think if you can't fill a job opening, you've had it posted for a while, you finally just say, what's the point? I'm not going to find somebody. Or you could be seeing your business slowing and say, I don't need that position anymore. But we've clearly seen a slowing trend for job openings. We were at 51% back in the middle of 2022. Now we're at 42%. And that's still a little bit higher than back in 2018, when it was 38%. But the trend is definitely less job openings. And I think that may well be, two things, like I said, slowing economic conditions and frustration of just saying, I posted this thing for over a year, I'm not going to post it any further. The last one is hiring plans. You can see that's the lowest. Right now, only 17% are saying that they have hiring plans. So I think that is something we need to pay attention to as well, is that to me is more of a sign that they're seeing slowing sales. So they're saying, we're not going to need to hire more people. We're going to be budget conscious, and we'll do with what we have. The other thing I wanted to talk about, I call it the myth busting. There's been a lot of discussion about what they call the labor force participation rate. What that is, it says what percentage of the civilian population is actually in the labor force to fill jobs, things like that. To be in the labor force, you have to either have a job, be working, or actively looking for a job. So if you're at home, able to work, but for whatever reason choosing not to, you're not in the labor force. So what I try to show here is what I've heard so much as well. The whole decline in the labor force is because the baby boomer population, which was the biggest population in history, is now retiring. So I decided, well, let's check and see if that matches what the facts are showing. So what this graph is showing, going back to 2003 as a starting point, and showing the growth rate. It's not showing the actual labor force participation rate. It's saying for each age group, how has the labor force participation rate changed? So you can see that red line in the middle. That is what we call the prime working age population, 25 to 54 years old, the typical age group where you're actively working. That looks pretty solid. You can see not much change one way or the other. what is surprising to many people is where the big decline has been, and this is the blue line, is not the 55 and over, it's the 16 to 19-year-olds. For whatever the reason is, and unfortunately I don't have an answer for you there, but we've lost that portion of the labor pool no longer looking for work. Maybe it's because they're staying in school longer. Maybe it's because of the changes to labor rules that businesses say it's too expensive to hire somebody that young and comply with all the rules and regulations. Whatever the reason is, you can see that was steadily declining. It dropped sharply like everything else in the pandemic crisis, bounced back up, but now it's declining once again. What we don't see is that same pattern for the 55 and over, which should be your retiring baby boomers. The trend has definitely dropped during the pandemic crisis, come up a little, and now it's just kind of holding stable. And you can actually see at the very end of that green line, it's once again turned up a little. I think that's the case of many early retirees who retired during COVID because their 401k had appreciated so much, their home had so much equity in it, they thought they could retire. They weren't prepared for the big spike in expenses, and now they're having to come back into the labor force. But I would say it's a myth to say the whole reason why the labor force participation rate is declining is because of baby boomers retiring. There's something else going on with the younger generation that if we can figure out as a country and as businesses and re-access that labor force or that labor pool, that would help some of the labor shortages there. The other one that's more astounding, though, or more interesting to me, is when I look at the difference, measuring growth rate once again, the difference between men and women. What I can show you here is even before the pandemic crisis hit, where we had the big drop, the gap or the growth rate for women was growing faster than for men. Then we had the big sharp decline. Now we see the same story, is that women are coming back into the labor force, adding to the labor pool. Men haven't really changed from the initial bounce after the pandemic economy reopened again. So here's another question is, why is that happening? I don't have the good answer again, other than it is definitely more acceptable for women to be working, to have two income earners. It's also a case now, especially after the pandemic crisis, that they're daycare again, so you can put them in your kids in daycare. But there's other cases where the millennials just aren't having as many kids. So that may be a case again that women coming right into the labor force. What I say to businesses is, I'm going to give you a long-term perspective. You say, well, that's just temporary. Here's my message to you. Whoops, sorry, let me click it right. This is going back since the 1950s. And this trend is irrefutable in the fact that our economy has grown because women have come into the labor force and continue to come into the labor force. So I know there was a lot of talk with the pandemic crisis or the pandemic recession. Everyone was calling it a she session because a lot of women had to stay home to take care of their kids because daycare was closed or because schools had gone remote. Now they're going back into the workforce. The men have been steadily declining. One of the studies says that some of this is tied to the opioid crisis, but it's all tied together. If that's the case, we're talking mental health things. If somebody loses their job, they become depressed, they start taking drugs to feel better, then you just kind of go down that downhill slide from there. But this is the real story, is that what I've told businesses, especially those that have historically been male dominant, maybe you're looking for the wrong labor pool, because the other thing I would tell you is if you look at the population, you can see the blue line is women, the red line is men. Women make up a bigger percentage of our population than men, and these are 20 years and over. So it's not kids I'm talking about, it's working age women. And I would simply say maybe some of the businesses like construction, manufacturing, other businesses that have historically been male dominant, maybe you're looking at the wrong labor source, that maybe you should focus more on attracting women into those industries. And I know we've seen cases like that. I saw a recent article out of Bloomberg where they were talking about some construction firms that were successfully bringing women into the labor force by offering childcare for them. It's different things like that I think businesses will have to get creative. But one of the things I would definitely say is I think we need to pay attention to the demographics of where's the bigger source of potential labor. And especially if that downward decline for men in the labor force continues, women is going to be your source to be able to grow, unless you're going to go to automation and robotics. So let me just stop here. Let's do our next poll. Carly, I'll read these off. I'll let you read these off, and then we'll see if we have any questions after this poll is done.
Absolutely. So our second polling question is, what is your biggest obstacle to growth? A, lack of qualified help. B, inflation expenses. C, regulatory burden. D, taxes. Or E, poor sales. And as a reminder, if you would like to receive CPE credit for today's webcast, you will need to respond to at least 3 of the 4 polling questions. And as another reminder, when you are answering, you will click in the slide your choice and then hit submit to make sure that your CPE answer is tracked. We'll just give it a few moments for folks to answer.
Sure. I know there's a couple questions. Let me just kind of tackle a couple while we're waiting for that. There was a question about what is the labor force trend for ages 20 to 24? I apologize, I didn't include that. It looks much more similar as the 25 to 54. It has not been trending down. It's been more flattish, had the same drop during COVID. So I was highlighting the 2 extremes for the older and the younger, but the 20 to 24 fits a little closer to the prime working age group as well. So what does our poll say, Carly?
Here are the
Inflation
responses.
expenses. So I would tell you as a group, you're very similar to the survey that the National Federation of Independent Business does with their small business owners, where inflation right now is slightly ahead of lack of qualified help. So this seems to be experiencing, people throughout the US businesses are experiencing the same issue with inflation and expenses, especially wage growth, things like that, being a major challenge, and then just finding enough qualified help there. So thanks for the response. I appreciate that. Let's go ahead and pause. And Carly, why don't you go ahead and ask, let's take a couple questions at least, and then we'll proceed on.
Absolutely. Someone from the audience has asked, thoughts on how the current war in Israel will impact our economy?
What we're going to see from the war in Israel, it should have minor impact to the economy, other than it will be a boost to our defense industry once again, as we supply equipment and munitions to Israel, just like we've been doing with Ukraine. That's not a huge part of government spending overall, but all else being equal, that would be a net plus. We don't have a lot of businesses US-wise that is heavily dependent on Israel. Medical is the one area there, the medical research field, biotech and stuff like that. There may be some consequences, but I think overall, there should not be a major impact to the US economy, and it's definitely not going to have a response from the Federal Reserve unless they saw something starting to happen with businesses.
And another question back to the topic of the labor force. Is there a relationship between the labor force participation between the 55-year-olds plus and the 16 to 19-year-olds? For example, seniors are staying in the workforce longer and taking some of the low-skilled or entry-level jobs that would otherwise have gone to 16 to the 19-year-old group.
I think that is one of the factors as we look at the different factors. The seniors, like you said, some of them, I would say though that what we've seen though is for seniors staying, working longer, they're not really taking those lower entry-level jobs. What it is that the seniors who retired early and then failed at retirement and now are coming back into the workforce to supplement their income so they can survive on it. I think those are the ones that would be competing with the younger people to work at, the McDonald's of the world and stuff like that. And I think the reality is when you talked with some of those businesses, their position is seniors, yeah, they're more dependable. They're a proven quantity. I'll take them any day over a younger person because I've been ghosted by the younger people when I thought I had somebody hired, stuff like that. So I do think that is a factor. I think just as much of a factor, though, is the change in labor laws and things like that. I know when I've talked with some of our businesses that are in, especially in the leisure and hospitality sector, they said, with Washington minimum wage going towards, I think, $18 this year, I'm not going to be willing to pay that to a young person that has unproven work skills. I would look to try and find somebody, hire them away from another business or something like that. So there's clearly a combination, but I think that's a valid observation is that when seniors are coming back into the workforce, willing to take those entry-level jobs just because they need to supplement their income, that means that they are, excluding or they're beating out the younger generation that way. Let's take
And
one
one
more.
last question.
I'll go on.
How far will mortgage rates need to fall for resale inventory to break loose, i.e. the people sitting on their 3% fixed rate mortgages? What will the impact be when this inventory does eventually flood the market?
I think that is frozen inventory because we're not going back to 3% mortgage rates. So I think in some cases, the only way you're going to see that happening is when people are forced to sell their house for some reason. I think it's actually could be the other way around, that as interest rates continue to go up, since it really takes two incomes to afford a mortgage payment these days, then what happens is if a recession hits or as the economy starts to slow, if one of those incomes is impacted, then you're putting your mortgage payment at risk, and you can see defaults happening because of the high interest rates and the continued high home prices, and that would start to put inventory back in the marketplace. I really think, just as I look at it, the 3% mortgages, I don't give you any hope that those people are going to be, other than some change in their financial position, that is what we call zombie mortgages now, because they're just locked there. They're dead for any type of refinancing and things like that. I think where we could see a big supply of inventory for the residential homes is from the private debt investors who've been buying up houses over the last 10 to 15 years. When rates were low, they buy up the house, convert it to a rental, and then they can pay a nice income to people who invest in their fund. I think there is a case now that if they find more attractive opportunities in something else that provides a higher return, or if they start to see defaults happening in their mortgage portfolio, they are essentially, I'd say, heartless. They just say, we're out. And they'll dump housing onto the marketplace because they'll be the first one out, and they don't really care what happens to the rest of the marketplace. But I'm not giving you any hope to say, hey, this is going to provide a ton of supply into the marketplace. I think we have a fundamental problem that this is not the 2007, 2009 housing crisis where we were making crazy loans that never should have been made, things like that. This is a fundamental supply and demand problem. With the millennial generation have reached the age where now they are having kids, they want a house. As home prices come down, I think buyers will come in to be buying it. So I continue to say, I think my thoughts for the housing market is, using your car tire as an example, more of a slow leak, that as prices come down, buyers show up and it kind of slows that pace, rather than a blowout where things just collapse. So I don't really see the formula for that. And I just, from my standpoint, I can't give you any real hope that the 3% mortgage people are going to be a source of income other than through older people passing on in life where that inventory becomes available, or something happens to them financially where either they're forced to sell their house to stay afloat, or they default on the mortgage because they couldn't make the payments anymore. Let me jump to our next favorite topic that people battle with, which is the battle with inflation. And what I say there is that we have to understand the difference between the Fed's definition of inflation and the consumers. The Fed says ignore food and energy. That's volatile. It works itself out. So they look at what's called core inflation, which excludes food and energy. What I say is, even using that number, it's at 4.3%. Their target is 2. That means rates higher until that comes down more. For the consumer, they're probably experiencing an even higher inflation rate because food itself up 4.3% year over year as of the end of August. Energy prices, the only benefit for them, down 3.6%, but it was up 5.6% in August. And we continue to see oil prices, holding up because of now with the Middle East conflict, but just with Saudi Arabia and Russia continuing to cut back on production to protect their profit margins. We're just not seeing an excess supply of oil out there. Shelter, anybody who's got their lease coming up for their apartment that they're living in or the house they're living in, is, those rates are still up 7.3% year over year. And then if you have childcare, up 5.6%. So I do think that the consumer may be experiencing a much higher inflation rate than what the public number is. But even using the Fed's own number, we still have a ways to go before the Fed says mission accomplished. So I think inflation will continue to be the Fed's focus. Where they worry about a lot is what they view as sticky inflation, and that's the service sector. The service sector makes up 58% of the inflation calculation, and service sector inflation was up 5.9% year over year in August. And I've heard different people. I had an employee telling me that she can't believe how much it costs to get her nails and her hair done now compared to a year ago, things like that. Service sector is much slower to lower prices compared to goods side, where you're competing with other goods and things like that. So your doctor bill, your dentist bill, things like that, I think that's far slower to see those rates coming down. So I think that's just going to be a challenge we have to continue to watch. But mission is not accomplished, and that's why I think the Fed will continue to hold rates at a higher level. If we look at going back to the National Federation of Independent Business, this is asking businesses what percentage you have raised your compensation and what percentage you have raised your prices, because I think those two go hand in hand. You can see the blue line since May of 2020 has steadily been trending up until recently. And we are at a peak looking at the blue line where we had almost 40% of businesses saying that they were almost 50% of businesses saying that they were having to increase their compensation. They immediately responded by having even a bigger percentage of businesses raise their prices. So this isn't the amount of the price increase. This is the percentage of businesses that increase their prices. Those were coming down. And now we see, and this morning's result was the same, 2 months in a row now, where businesses raise prices again, trying to offset the effects of higher oil prices, energy prices, things like that. So I think this is just something we always need to pay attention to, because the risk here is what they call a wage price spiral. The more you raise wages for an employee to keep them with you, most businesses will turn right around, if they're able to, and pass that through to the cost of their goods and services. And that's what the Fed is terrified of, because that's what happened back in the late 70s, when a lot more of the wages had a cost of living increase attached to it. So as inflation went up 10%, wages went up 10%, and spending just continued on, and it just created this vicious cycle upward. The Fed does not want to see that happening again. So they're monitoring closely the behavior of businesses. And if they're putting through wage increases, are they putting through price increases? So far, that answer is yes, but at least there's less businesses doing than the peak that happened back in the first quarter of 2022. Then asking them, well, what's your future plans for prices and wages? We see that recently, it had kind of leveled off and was pretty steady. Recently, we've seen a slight uptick in the percentage of businesses who said that they're going to have to raise wages. And you see the same response saying they're also going to raise prices in an attempt to recover the cost of those wage increases. So again, something we need to pay attention to, see what's happening. I know I've had questions, well, what about all these union settlements with, American Airlines, with UPS, and now with the United Auto Workers? Well, the reality is they on their own have very little impact, because union jobs make up a far smaller percentage of total jobs compared to the late 70s and early 80s. But the real concern the Fed's worried about is what happens if employees at non-union places say, well, wait a minute, they got this increase, how come I'm not getting this increase? And forces non-union businesses to raise wages as well. So that's something I think we're just going to have to keep a close eye on, because that will help determine when the Fed is really truly done raising interest rates. The unspoken inflation, this is what I'm talking about, the wage growth. You can see here for the various states, and apologize, I probably didn't catch every state for people who are joining in, but Idaho, biggest example, they have been massive labor shortages, trying to fill jobs. And they had a year-over-year wage increase at the end of August of 7.8% compared to the U.S. at 4%. And really the only state that was below the U.S. was Washington at 3.8%. No matter what, all of those increases, even 3.8%, is more than the Fed wants to see. And I think that's why I call that the hidden inflation, because wages are not part of the inflation calculation. Inflation is measuring the price of goods and services, not wages. So that's something that's just a risk we have to continue to pay attention to, because what we see, they're trying to, employees want more wage increases because see their expenses going up. And this is the biggest unspoken inflation that I talk about, is the dramatic increase in home prices in so many states. And what this graph is showing you is, if you're trying to get a mortgage based on just one salary, what percentage of your salary would be consumed by the mortgage payment? That's using the median home price in the area. I use 7.5% mortgage rate, is what existed at the time when I was running the calculation, and then a 30-year mortgage to give the longest amortization. And you can see for the US, it's 55% basically. All the other states, Washington at almost 75, well, in fact, Washington at 70%, Oregon at almost 75%, Idaho almost 75%, and then Montana with a big move of people from California and other places thinking it's a great place to live, 104% increase, 104% of your paycheck. Because the problem you face with a lot of these states, especially places like Montana and Idaho, they have some of the lowest wages in the US and yet the highest home prices. So what this says is it takes two incomes to qualify for a mortgage. And as I talked about before, if you're dependent on two incomes to buy a house and one of those incomes becomes negatively impacted, you could suddenly be losing your shelter or your house. And that's where we would see inventory showing up. So this is a huge challenge for the US. I don't have any good answers, and we could have a whole separate session talking about ideas of how to address this. So I'll just leave it at that for you to think about. And let's move to our third polling question. Carly?
Thank you, Steve. What type of wage increases are you anticipating for 2024? A, 1 to 3%, B, 4 to 6%, C, 7 to 9%, or D, more than 9%? We'll just give a few moments for our audience to answer.
And I'll just answer one quick question related to the housing thing. The person wanted to know, does the housing price chart include real estate taxes and insurance? No, this is strictly the median home price in the various states. So it does not include your insurance or your real estate taxes. So that's just one more burden of saying you got to have two incomes to be able to afford to buy a house and keep that house. And you're even more at risk if you lose or reduce income for one of the people because you have those other taxes or other fees that go with your house.
And here are the results, Steve.
Not an encouraging picture, I would say, although it's more encouraging that almost 41% to say in the 1 to 3% range. A year ago, that would have been probably 4 to 6% was the lowest, but still saying we've almost got half of the people saying that it's going to be somewhere in the 4 to 6% range. That would worry the Fed if they saw those kind of results, because they're just saying that could continue to support people spending at too fast a pace and continue to keep inflation from coming down more than what they want it to. So great feedback, not necessarily encouraging for me, but valuable to understand. So Carly, why don't we take a couple more questions? I'll cover construction spending because we still have some time, and just kind of keep rolling some questions through rather than waiting till the end.
A question from the audience. What has the Fed found are the biggest drivers of inflation at this stage?
Started with goods because of the classic economic model that says if you increase demand but you don't increase supply, you get higher prices. So during the pandemic crisis, we gave lots of stimulus money to the consumer while we still had manufacturing restricted on their production levels and things like that. So that kicked off inflation. It was goods driven. And then from there, what happened was because consumers had that money and especially didn't have to make, for almost 2 years, didn't have to make their rent payment or their mortgage payment because they had either moratoriums or freezes, and they haven't had to make a student loan payment for 3 years. They used that extra money rather than building up savings. They started to use it for the service side to travel, what they call revenge travel, things like that. So I think that the Fed really believes, when you listen to them, they believe, and they're just as, I would say, almost as much as responsible, but the inflation was caused by providing too much stimulus versus the capacity of being able to produce the goods and services that people would need. That there was a belief that that money would, if it met your bills, that then it would go into savings and things like that. That's not the case. I mean, savings rates spiked dramatically at the beginning and has steadily come down from a peak of, I think it was almost close to 20% at the end of September 21 when we had the last of our stimulus stuff, and now it's down to 3.9%. So the people have been spending that savings. They have not been setting it aside. And yet you still have this issue that first we had supply constrained by lockdowns and things like that. Now it's labor shortages that is creating the same problem. So I think that's the main factor that they see.
Another question for you. Will regional banks be able to absorb the commercial real estate devaluation, or are failures on the horizon?
There are going to be failures, but I don't think it's going to be the apocalypse failures that so much of the press have tried to portray. I think one of the things is because commercial real estate, and really when we're talking commercial real estate, is commercial real estate office and commercial real estate retail. Commercial real estate on the other side is not showing signs of stress. And I think the problem compared to the apocalypse scenario is that long-term leases exist, so they're anywhere from 3 to 10 years. So it's not happening all at once. It's happening gradually. And I think that's giving some places, businesses opportunities to work to handle that when their debt comes due for refinancing. So I do think that the weaker run lenders, whether it's financial institutions, private lenders, whoever it might be, who didn't have as strong a credit standards to qualify for people, they based the model on, 3 to 4% cap rates and said this is profitable. And now they're talking, much higher cap rates. So we're going to have failures, but I don't think it's going to be widespread. And I think it'll be the same for the regional banks. Many are well reserved, well capitalized, and they'll be able to handle that. Others have been very conservative in their lending. I mean, Washington Trust is an example that our corporate bankers hate our credit approval people because they're using a 60% loan to value rate. They've always used it. They didn't budge when times were easier. They just said, well, we'll just lose that business. And I think you'll find there are many well-run regional banks that'll be just fine and maybe have opportunities to pick up cheap, defaulted real estate. But I just think it'll be more of an ongoing thing over the next 5 years or so, not an all-at-once thing that happens, which would cause an apocalypse type of scenario. Let's jump into. Okay, go ahead. One last question.
How would a proposed 10% tariff on all goods imported impact inflation?
A 10% tariff would make prices for U.S. consumers higher. That's something we learned very clearly during the Trump administration when he said that China was going to pay for these tariffs. And what, the lack of understanding was when you impose a tariff, what happens is the foreign good comes to the U.S. port. The port authority, when the buyer comes to pick up their goods, they assess that 10% tariff at that time to the person picking up the item. So the item costs 10% more than it would have otherwise. So that means, once again, all else being equal, you put a 10% tariff on, what you're going to see is business trying to pass through the cost of that tariff to the final price of their goods and services. That keeps inflation at a higher rate or potentially even increases inflation again. So that would not be a good scenario for trying to battle inflation. Well, let me give you a rundown of the construction industry, because that's been one that during all of the questions about are we in a recession or not, is the business cycle ended or not, construction has kind of been a shining star. So I wanted to highlight, because some of you may be looking how to jump out of your window by the time I finish talking here. So I wanted to give you the silver lining of where there has been very good news going on there, and I think probably will continue, other than the labor issue. But this is what I'm showing you. This is construction spending. The blue line is total construction spending. You can see there was a minor little dip during the pandemic crisis and then just has steadily moved forward. Another minor dip when the Fed first started raising rates, and now people have, I guess, adjusted again. So solid growth out of construction spending. You can see that we've got the non-residential, the the red line is growing while the green line, which is residential, has fallen. One of the interesting features, if you look there, you go back to the 2006, 2007 timeframe, you see this kind of inverse pattern. Residential construction collapsed because of the housing crisis. Non-residential then passed it, and there was more spending for non-residential. Then as the economy got stronger, interest rates got lower, we saw heading into 2022 that residential construction had passed residential construction in total dollar amounts, and then it's dropped off again because of the drop off due to the high interest rates. And now you've got non-residential leading once again. So positive news there. We are still seeing construction activity going on. When I look at it, trying to break it down for you more, it's very clearly private construction spending, not government construction spending. I think some of the challenge here is that the infrastructure funds have not been fully rolled out on the government side. Plus, they're struggling that a lot of construction firms are saying, I don't have enough labor already. So it's a zero-sum game. Do I want to do government construction or public construction, or do I want to do private? And quite often the answer is too much red tape and bureaucracy for the public side. I'll stick on the private side. And you've seen there's a very strong growth in private residential construction. Now, I would say when I show you the next graph, it isn't universal. It really is one area where we've seen this massive growth. And this has been in the manufacturing side. The black line is manufacturing, tied primarily to two things. Tech production, as businesses are bringing some of their chip manufacturing and things like that back to the US, that they're building plants for that. So we're seeing strong growth there. Example is just even in the local regional economy, Micron with their big expansion plans for their chip production. So that's driven it, plus the green initiative and many of the incentives that the Biden administration has provided to businesses. So we've seen a lot of ramping up of battery manufacturing plants for EV vehicles and things like that. So that's really been the driver on the manufacturing side. The one thing I wanted to highlight, though, you might not be able to see it real well, but if you look at this, the bright green line, that is spending on office construction. So when people talk about this collapse in the office market and we're going to have this major decline in prices, I just simply say, well, it's interesting because even though they are at a lower volume than some of the others, there's not been a big drop off in spending on office space. So that I found a little fascinating, but I think once again, there's still opportunities for businesses, just not as much as before. So that's the picture I wanted to give you for construction spending. Let's jump to the last as we're nearing the end here. Are we heading for a recession? Is the business cycle over? So before I answer that question for you, I'm going to have you tell me, what type of economic growth do you anticipate over the next 6 months? Carly?
And the answers to the polling question are A, same pace as now, B, slowing growth, soft landing, C, negative growth, recession, or D, severe recession. We'll just give a few moments for our audience to answer.
And just to give a quick, just so that I'm scanning questions, the one that was directly related to construction. So let me answer that while we're waiting for the poll to finish. The question was, could we bring migrant construction workers to combat the construction labor shortage? I would say that's an answer not just for construction, but overall, immigration has always been the solution for the US for its labor because we're a nation of immigrants. And the fact that we've got a broken immigration system now where we're essentially stopping legal immigrants just as much as illegal is adding to this issue. So I would say absolutely, if Congress could get their act together, work with the administration to clearly define legal versus illegal, allow the legal in to fill the needs that we have, there would be plenty of opportunities to bring in the immigrant construction workers who would help fill those needs. It's no different than manufacturing or other places.
And here are the responses to the poll, Steve.
So that is pretty evenly distributed. The most, almost 40% think it'll be a slowing growth soft landing, followed by 32% thinking a recession, and then 25% thinking that things will just continue the way they are right now, which are very, they're strong for the U.S. They're projecting economic growth for the fourth quarter to be in the 3 to 4% range. So that would be interesting to see if it happens or not. So let me answer your question for you. I'm going to give you, rather than trying to, because everybody's got their own thoughts, and there's plenty of economic news out there that you can go either way to make your argument for a soft landing or recession. But there's a firm that puts out a dashboard. They've been doing it since the 60s, uses 12 different economic leading indicators that have had a historically good track record. And then it gives you the bottom line. If it's green, the economy's fine. If it's yellow, then it's slowing and possibly in danger. And if it's red, that means within the next 12 to 18 months, we would normally see a recession. And the answer is, right now, if we believe it at all that historical stuff is still accurate, maybe it's not, but I'll just throw this out to say 10 out of those 12 indicators are saying that we are in the situation that normally would lead to a recession. The only time that we haven't had that, just to give you its track record, this just shows you that going back to the 1969, 70s, that it accurately forecasts that except for two scenarios. One was 1973-75, which is when the Arab oil OPEC oil embargo was put in place in the U.S., and that was instant. It was a severe shock, caused a recession. The other was the pandemic crisis. We all know that story. So I'm not guaranteeing anything. What I'm just simply saying is we always have to think of, well, what's the thing that, the risk that we should be planning for? Nobody has too much problem handling the positive. It's whether you're prepared for if the negative comes around. So what I would just simply tell you as I look at this information is my thoughts for you are that, one, as I've said before, recessions are unique to each person and each business. And I simply advise you to pay attention to what you are seeing for your business or for your client's business and not what the media is saying. Because you'll see it starting to change faster than the economic data will pick up. And you'll definitely, if you're not seeing what the national media is saying, then the last thing you want to do is change what you're doing and suddenly try and go a different way to be defensive and discover that you should have stuck with what you were doing. I've said all along that recessions are a natural part of the business cycle. They always occur. The only real question is when. And I would rather be giving you the advice to prepare now rather than wait to see when it actually comes around. Because as I was taught when I first started in the career, I was actually on the sales side at that time. My sales boss always said the time to build your pipeline is when times are good, not when times are bad. I would say the same thing for a recession or a negative type of thing. As an effective risk manager and just being a good business person, now's the time while times are still good to prepare and say, I've got a game plan. I know what to do. For those of you who have heard me speak before at this conference, my favorite term is have an economic disaster recovery plan, just like you have an environmental disaster recovery plan. Because if you're prepared ahead of time, when it does happen, you'll be the one who can be looking for opportunities rather than trying to hold on and survive because you weren't ready for it. And the last thing I would say is, beware of the self-fulfilling prophecy. Because if you're listening to, negative news and suddenly you become extremely defensive, then you run the risk that, boom, we end up in a recession because everybody starts behaving like we're in a recession. So I'm going to leave it there at that. I think, like I've said before, times of, bad times are usually when opportunities come up. So rather than being worried about a recession, if you plan ahead, I think you should look forward to the opportunities that will come along. And Carly, I'll turn it back over to you.
Absolutely, Steve. We've got a few minutes just for a few short questions before we close out. But Steve, can you share your thoughts around the growing national debt and the impact that might have?
Well, it's a problem that's not going to go away. We need to deal with it. In the short run, the U.S. has the only benefit that we're the best house in the bad neighborhood. So there's no real alternative currency to be able to say, I'm going to put it here instead of with the U.S. But every dollar that we keep adding on to debt, that bill is going to come due sooner or later. And right now, we're already seeing some of that negative impact for government spending, because before the financial crisis, interest expense as a percent of tax revenue was 6%. Now, given where interest rates are and the fact that the Treasury has over 50% of its debt maturing within 3 years, it's up to 15% of tax revenues. That's going to limit the ability for Congress to do any more deficit spending. That, in one sense, is good news, but for people hoping for more stimulus during a recession, that'll be bad news.
And thank you, Steve. We are at the top of the hour. Any questions we didn't get to, we will be answering via email. Thank you so much, Steve, for a great presentation. And thank you to our audience for joining our second session of the 2023 Virtual Building Opportunity Conference. We hope to see you for the next one coming up on October 17th, which is Design Office Space Buildings for a Radically Changing World. If you met all CPE requirements, your certificate is available to download now in the CPE progress window. A copy will be emailed within the next 2 weeks should you have difficulty downloading it now. And finally, we would like you to answer a brief survey for us. Thank you so much for everyone for attending, and we hope you have a wonderful day.